Well, good evening and welcome to this live stream on the first day of August 2023. It's Martin North here from Digital Finance Analytics. Great to have you all on tonight. And you'll see that I've changed my background. So the new studio is now coming together quite well. So I'm not using the virtual background anymore. I'm using my own background, which gives a little bit more presence, hopefully, to the show. Tell me what you think. And I've got a few more enhancements to make, but they're pretty much coming along. Now, of course, Damien's ready to come in. Just before I bring him in, let me just remind you, as normal, we don't provide specific financial or legal advice on the channel here. This is a general conversation. We do moderate the chat, so please play nice. This is as at the 1st of August 23. If you'd like to ask a question, we do encourage questions. Use at Walk the World. That'll get my attention and make sure that it comes into the queue. And I've enabled Super Chat, which means that if you want to get your question top of the list, you can do that, or indeed make a contribution to what we do here. Always greatly appreciated. Always plenty of stuff going on. Anyway, let me push this button. Damien, hello.
Martin, how you going?
I'm very good. How are you going?
Yeah, very well. Very well. It's been a very warm midwinter. It almost makes you think spring's around the corner here. So I'm not sure how it is over your way.
Well, we had a very nice June, and then we had a horrible July, a lot of rain, and it's still forecast to rain over the next few weeks. So it is quite interesting, just the different temperatures. June was amazing. I mean, it was literally like an Australian summer. So it's pretty. Right. People were complaining about the heat, of course, but now it's a lot cooler. Boy, there's lots to talk about, isn't there, with the markets and everything else at the moment. Look, I guess the fundamental question is there a head fake going on at the moment? Because, of course, many of the market participants are now saying, oh, maybe the bears are getting crushed and maybe the markets are going to reach new highs and maybe everything's going to be perfect. And, it's almost like nothing can possibly go wrong, except I'm not quite as convinced as some.
No, and I'm on the same side of skeptical. And we spoke last time about saying this reporting season is really important, and so I guess and so we'll jump into that. But I do think there's a real element going on at the moment, which is that we're sort of sitting in this. We've gone from a period where we had a lot of bulls. So a lot of technical bulls, or a lot of and we spoke about the traders throughout there who'd have been buying up the market last year, whereas a lot of the fundamental guys were sort of sitting on the sideline. And that was the danger in terms of seeing markets continue to rise, was that one by one fundamental analysts would just go, look, I don't know what's going on, doesn't seem to be falling. I may as well buy back in. And I do think there's a big element of that, and I'm certainly seeing it throughout the research you read, where it's sort of people are just like going, yeah, okay, I was wrong. I thought things would be worse. I'm not quite sure why they're better, but you know what? It's a bull market. Jump on. And I guess the danger at this point in the cycle is, we're sitting at sort of pretty close to record high valuations. Earnings do seem to be coming down, but that not as fast as I would have thought. But there is certainly that they're not positive. And so, it is a strange time to be buying. It'd be a strange time to be buying markets on record highs. Like most of the times when you get these record highs, there's a reason for it in terms of it's a story about how great the growth is. Whereas this seems to be that one of two things. One is that either earnings are going to hold up, but inflation is going to fall away, and the Fed's going to start cutting rates. And so you're like, well. So how does inflation fall and the Fed start cutting rates and earnings still manage not to fall at the same time? Or you've got this AI idea that, look, AI is going to be, it's going to be a huge tailwind to earnings. And I do think it's a tailwind to earnings, but I just don't think it's a tailwind to earnings over the next year or 2 years, or even within the sort of foreseeable period of time, in that we've been looking at just trying to work out how big the market is, and it's really hard to see where you can see the earnings. A company like Taiwanese Semiconductor Manufacturing reported, and they're looking at basically we've got earnings downgrades. So the world's largest manufacturer of of semiconductors is been looking at earnings downgrades and reported a pretty bad quarter, to be honest. And at the same time, there's a story that, hey, there's an AI boom going on and it's going to lift everything. And it's like, well, I don't doubt there's an AI boom going on, and I don't doubt it's going to be good for, in terms of longer term for productivity. But if in the short term it can't even lift Taiwanese semiconductor manufacturing, then what hope does it have of lifting the rest of the market?
Yeah, absolutely. And what I find really fascinating, because I was watching the Federal Reserve and then the Euro area, and they both basically were not wanting to communicate anything to the market. It was like a non-event, right? I mean, they spoke for an hour, and all of the questions were about, where do you think rates are going? Will you hike? Will you not hike? And they were just sort of, we'll wait and see what the data is going to say, and all those good things. And it was almost as if they were deliberately not wanting to give any signals. Now, maybe that's because they're going on holiday for a month, and by September it'll all be different again. But there does seem to me to be a bit of a disconnect between what the inflation is actually doing. And it's coming down a little, but the core elements are still pretty sticky. And what the markets are saying, because the markets are still, I think, pricing for perfection at the moment. And what I find interesting about that is I don't see the justification for it. I mean, okay, the AI thing is quite significant, but how significant? And there are many other sectors of the market that are looking a bit wobbly. Look at some of the results. We might touch some of those. And yet there's been a broadening. So, we had the tech moving up. Now even the small caps are moving up. So I'm finding it really quite complicated and difficult to call what's really going on and where it might go, because I think there's still a lot of risks around.
Yeah, well, if that's sort of, I'll pop up a chart to show you. This is, I've just thrown up over the last month, the market reaction to earnings. So on the x-axis, I've got the amount that 2024 earnings per share has been revised either up or down, and on the other axis, I've got the change in price. And so I don't know about you, but I can't see a picture at all in that. It's basically a random scatter.
I was going to say, it looks completely random, which is sort of what I worry about. Maybe there is more randomness here than people would want to recognize.
Yeah. I mean, this top left quadrant is full of companies that have downgraded earnings by 20% and have risen their share price by 25%. And so there's some, earnings are... We seem to be going through a period where it is the story that matters. It's not the earnings that matter, and those don't tend to end well. Maybe this time will be different. Maybe maybe they'll hold up forever. But yeah, it's that's one. A few of the other ones. I think because I did speak about last time, saying I really do think this is a pivotal reporting season, and we are getting close to halfway through it. Having said that, the earnings forecast will still see the revisions over the next sort of week or two, really to catch up to the half. So we're probably, in terms of earnings forecast, we're probably only a third of the way through. But we haven't seen as much weakness as I would have expected. But then again, we're not seeing much strength either. So this blue line in the chart is the 12-month forward earnings. So what that is looking at is that's saying, if I look at all companies and sort of average them up and market cap weight them and everything like that, and try and look forward so that at the moment it's got 5 months of 2023 and 7 months of 2024, and then in another month's time we'll be down to 4 months of 2023 and 8 months of next year, and so it's just sort of gradually moving forward. And so the things we're looking for is these big downturns where you get some big sort of quite shocks to earnings, and that really puts a dent in valuations. Now, we had earnings sort of slide away for a year for 2022, and they've picked up. So this sort of the end of this line, you can see where earnings have sort of picked up a little bit. Now, that hasn't been because the actual forecasts have been going up. So you can see 2023 numbers are in red there, and they've actually been coming down consistently. And 2024 numbers have been coming down. It's just that there's so much growth already baked into 2024 that as you get a little bit less of 2023 and a little bit more of 2024, it keeps looking better and better. Oh, sorry, that line keeps rising. And I guess the question is, will we get sort of 12% earnings per share growth next year, which is what's sort of factored into the market at the moment. And even more starkly is if you look at the quarterly numbers. So this is our sort of this is for 2023. We can see those quarterly numbers have just been downgraded, and over the last 12 or 18 months, we've just seen downgrade after downgrade after downgrade. And Q2 numbers, which are being reported now, are coming in below Q1. Q3 numbers have sort of been downgraded, and so we've got another 3 or 4 months, and I expect them to come not too far above Q1 and Q2. The issue is this Q4 numbers, where if we dig back and go one step further from this line into what's the growth rate, what growth rate is forecast, we're basically looking at Q2, which is the one we're in now, coming in at basically down 10% on last year. Q3, was forecast to be 10% 9 months ago, but now it's below zero. It's now down to being forecast at sort of -1% and falling still. Q4 is still forecast to have an 8% return. So it's basically saying, and keeping in mind that Q4 starts in less than 2 months' time. We start our Q4 quarter. And so I think there's risk for that number. And that line has held up a lot more strongly than some of the others. Now, some of that is AI. Some of that is, so in particular, when you look at Amazon, Microsoft, Google, Facebook, those types of companies make up probably about half of that gain in terms of that number. But there's still a lot of other companies that are looking at sort of numbers that are way too high. And often, some of those companies have had pretty good returns over the last little while as well. But so I'm expecting some more earnings downgrades, things I guess moving in the direction I'm expecting, but probably not as fast as I would have expected. Like usually by now we would have started to see those Q4 numbers come down quite substantially. Like if you look at these other lines, you sort of get these step downs as you get it sort of closer and closer to the numbers, and analysts start focusing on it. And it's sort of surprising we still haven't seen that in the Q4 numbers. Maybe there's some sort of extra growth there that I don't know about, but yeah, I'm still skeptical.
So one of the things, of course, to observe is that the peak of interest rates has come back a little bit from where it was, and if you apply the principle that a lot of tech firms in particular are measured on their earnings into the future, it means that the discounts into the future have actually dropped a little bit. And it seems to me that's probably one of the reasons why it is that some of the expectations of future earnings have actually held up, simply because interest rates have come down a little relative to where they thought they were going to be.
And look, we've had some reasonable results from the big tech companies. I mean, Microsoft disappointed a little bit, but actually the underlying earnings are still pretty strong there. Facebook came in with some, or Meta, as they're now called, came in with some pretty strong earnings. We know about NVIDIA. We spoke a lot about NVIDIA on prior episodes, but there's still a reasonably big group of companies. Then there's the rest of the market. If you haven't got AI in your name and you're not seeing sort of direct growth from that, I spoke about Taiwanese semiconductor manufacturing. They're sort of the world's biggest foundry. They make the chips for NVIDIA, and their earnings they've been downgrading earnings. One of the biggest falls we saw in terms of 2024 was Micron, and Micron makes they make memory chips. So some of that's to do with China, but there's other companies that are sort of cut out of China as well. And if there's one of three, the three biggest memory chip providers in the world, and so if you can't be making money if you're not seeing those types of companies making money in this environment, then it's hard to see how how the AI boom is going to spread to every other sector over the next 12 months and suddenly increase the profits they're making. The other interesting one on the companies as well is the we're seeing more on the debt side now as well. And it's quite interesting that there's actually a reasonable number of companies that are making money. They're making a positive spread on some of their prior loans.
Yeah.
So they managed to get money away at say 2% interest rates or 3% interest rates over the last couple of years on 10, 20-year debt, maybe 20-year debt, but 10-year plus debt. And now they've got cash sitting in their bank account. And they're like, well, do I pay down the debt that I've got? But that was at say 3%, but I'm earning 5% on my money market accounts. So maybe I'll leave it in there and I'll actually make a positive spread. So there's and so the effect of those rising interest rates. There is certainly a delay component to the US, given how many companies manage to refinance at lower rates. It's quite the average tenor of the borrowings on the market borrowings has sort of risen by about 3 or 4 years in terms of how long before they're going to pay back the debt over the last, say, decade and a half. And so what that means now is I think we're up to closer to 8 years now, is that it just means that only 1/8 of companies, or even 1/8 of a company's debts is sort of rolling off in any 1 year. And then they're resetting to higher interest rates, and then they're the next one's coming off the next year. And so the effect of the higher interest rates on companies and the cost of their debt is taking longer to come through. And then we know in the US as well that with 30-year mortgages, there's some quite incredible stats coming out in terms of the amount of people that have refinanced and how far interest rates would have to fall before people would need to refinance. Would be interested in refinancing again, and it's you would need sort of 2 or 3% come off current interest rates before even so I think maybe 20% of people might be interested in refinancing in the US. And what that means is, yes, while some people, well, sorry, not while some people, while there's a vast amount of people in the US who are locked in at low interest rates, they're also locked into their current house. So what's happening is the new home market's been a bit stronger than many would have expected, given how high interest rates have risen. But the reason why is because I might have moved into a 3-bedroom house, say with a couple of young kids, and I locked in my mortgage for 30 years at 3 or 4%, and now I've got to pay 6 or 7%. And then I'd love to get a 4-bedroom house because we're just another kids on the way or whatever. But do I want to get a 4-bedroom house at a mortgage of 7%, or do I want to keep my 3-bedroom house with a mortgage of 3.5% for the next whatever period? And so more and more people are sitting there going, well, I'm not going to upgrade. And so new people coming into the market, even if they can afford the 7% interest rates, are going, well, there's nothing to buy on the existing market, so then I have to go and build something. And so so that's sort of kept the US a little bit stronger than expected as well. Now none of these are both the company and the individual ones. They're not forever tasks, but it's just one of those ideas about that long and variable lags that because we went through that period of really ultra low interest rates and a long enough period that a lot of people locked in, particularly in the US, that's got longer to go. Now, the flip side in Europe is that they don't have as much market funding. So most of the funding is through the banks, and the bank lending tends to be a much shorter time period. So it's affecting Europe earlier. And then in Australia, we know, we've got obviously a lot more floating rates here than fixed rates, and also in mortgage markets in Europe as well. The length of the mortgages is much lower, and so we're going to be seeing that effect happen a lot sooner in for companies in Europe and to a certain extent Australia, but for individuals in Australia and then Europe and then finally the US in terms of the lags there.
Yeah, it's interesting. I was listening to someone the other day arguing that, well, maybe it's not about lags. Maybe because of the structure of the economy and everything else, actually the impacts have percolated through to the extent they're going to percolate through. And it's partly because of this fixed rate interest rate in the US example. But somebody else was arguing, well, no, this is a recipe for stagflation. In fact, stagflation is where we're headed. And in fact, Blue Army asked a question a little while ago: is stagflation more likely now? Therefore, what's the best investment apart from gold in a stagflation condition? I guess it's a really interesting question. Stagflation, in other words, will inflation come back down, or will it actually hang around? And if it does hang around with weaker earnings, and therefore companies borrowing less because they can't see where they're going to sell more. I mean, there is a bit of an argument that maybe the stagflation thing is worth considering.
Yeah. So I think there's two parts to that. One is will inflation stay higher for longer, and we'll sort of take that as the other part. And then the second one is, will we see unemployment rising? Now this is, and I guess this is the part which is why we've seen the Fed happy to keep raising rates, and is that we've seen relatively strong wage growth in the US, and unemployment stayed low. The flip side in Australia is we've been seeing, we haven't seen much in the way of wage growth, but we have seen unemployment stay low. So our wage growth has been very muted. Okay, so that's Australia. Then we look at somewhere like the UK, where certainly, we're seeing inflation, really booming still, and not coming back anywhere near as fast. So could you see it in the UK? I guess there's more of an argument for that. When we look to other countries, so not Germany, China's in outright deflation now, so they're suffering from. You're certainly not seeing any signs of stagflation from China, and Japan. They're sort of happy now that they might have managed to get some inflation, and they're tentatively thinking about maybe they might stop. That was the news over the last week or two has been maybe they'll let interest rates float a little bit more, the long-term interest rates float a little bit more, and maybe they'll let them go above 1% or they'll let markets sort of determine a little bit more whether they should be above 1%. And so I think within are we seeing this broad-based stagflationary around the world? No, we're not. Are there particular countries where you could see that effect? I think you might be able to make an argument for. I think England's probably one of the key ones. I think Australia, I don't think you can make that argument in as far as we're running this record immigration level. That's going to keep our wages really low. I think that's going to make it much harder for inflation to flow through, or much harder, for inflation to pick up and start circulating. I guess the only disclaimer on that front is, as long as we don't see house prices get too, and rents hold up that inflation and energy, in that I think we've the rest of the world sort of seeing energy price come down a fair bit, but Australia has done a very poor job of managing our energy, and we're still seeing quite high energy sort of inflation coming through. So yes, a long-winded answer, but I think there's a market by market concern you have to have. And the other thing is, if we do have a genuine downturn, inflation will disappear very quickly, and it did even in what notionally stagflationary periods. When you do go into recessions, inflation's pretty quick to fade away. It might pop back really quickly on the other side of it. That's the danger. But I think there's an argument for. I think the argument that inflation could hold up even during a recession, could well be put to the test over the next little while. And I think that I don't think that is going to be the case. I think even if I was a stagflationist, I'd still expect that recessions or at least significant downturns would be enough to wipe out some of the inflation. And actually, it's a good jumping off point for this food, because we spoke a little bit about the food conundrum last time, and there's a little bit more on it, but I don't know whether it's helping or hindering, but it does seem to be very much a developed markets thing. So I've got some charts up, just showing. Now this is the UN Food Price Index, and the charts aren't particularly nicely formatted, but just bear with me for it, and I'll explain what they're doing is. So we've got this food price index on the left, and the orange line is 2022 over the course of the year. And so it spiked massively higher for food prices when the Ukraine war started, but then faded for the rest of the year and ended up back where it started. And then in 2023, it's fallen even further. So we're still going down in terms of this. Now, keep in mind, these are UN food prices. I know everyone out there is going, just a minute, this isn't happening in my shopping trolley. So, and then you look and you go at each of the individual ones and you go, okay, vegetable oils, over the course of the last, whatever it is, year or so are down, 50%. Cereals are down 20 or 30%. Sugar's up, but everything else, dairy, meat, all these things are down. And we spoke last time going, yeah, okay, there's something weird going on here, because that certainly isn't happening in my shopping center, and it's not happening in most sort of developed markets. Actually, I'll jump one more forward. You look at Spain, and Spain's, I don't say solved its inflation issue, but certainly it's got some of the lowest inflation in Europe at sort of 2% for its inflation. But Bloomberg run this sort of Spanish paella index, and it's running at 15% in terms of the food inflation there, and it's been high for a significant period of time, and that's sort of all the different elements that are going into that. France they run then a coq au vin index for France, and then say similar type of thing and say, well, that's running at sort of double ordinary inflation. So whether it be poultry or wine or mushrooms or carrots up 48%. And so so what we're really seeing is this developed market food inflation that's really flowing through. Now some of that will be higher fertilizer prices, but that just doesn't cater for it. Some of it's transport and packaging and higher wages and things like that, but it just doesn't. None of that adds up in terms of why it's so high. And then if you look at consumer goods groups and their expectations, they have crashed in the last little while. So they're not back down to zero. They're not expecting outright deflation, but they are expecting, we're back to ordinary long-term, or below sort of ordinary long-term food prices. So it's really interesting that we're seeing, it's a developed market, not an emerging market phenomenon, and I think that's why you see when you look at the UN index, that's in a way that's person weighted in terms of if I eat whatever it is, 300 grams of rice, then I'm going to be pretty full. It doesn't matter whether I'm in a developed market or an emerging market or whatever it is. And so, if you've got 1 billion people in your country, then you'll make a bigger difference to that index. And certainly prices in a lot of developing and emerging markets are really just aren't that high. And so it's hard to see. Yeah, I guess I'm struggling to see a stagflationary argument where all the emerging markets will be fine, and China will be in deflation, but the rest of the world will be in inflation, or having a stagflationary one, especially in some of these more commodity type goods. But despite that. I'm struggling to see it. We have seen it over the last year. It's just a question is that going to fade away now? And I think it will. But if you had have asked me 12 months ago if we'd see deflation in food or in most emerging markets, would we still be seeing 15% inflation in Spain? I would have said no. But that's what we've seen.
Well, I'll tell you, we had some information here in the UK literally today, and they're celebrating that food inflation has dropped. It's now at 13% per annum rather than where it was it was 19% some time back. And so if you look at the information, what they've said is there are some categories like oil is down a little bit, but there are lots of other things that aren't. And then they were saying, well, there's still base effects, so that there's more costs to drop out. But they're also saying it's unlikely that we're going to see inflation in the food sector come back within anything like the target of 2% or whatever. And the other point there is, and they've really now picked up on this, they're arguing that not everyone's equally impacted, right? Because, of course, people with less incomes spend a greater proportion of their incomes on food, and so their inflation rate is way higher than whatever the average is. And, of course, the average here in the UK is still very high. The Bank of England is expected to lift rates again this week by probably 25 basis points. And they're still saying there's going to be maybe a 5.75 or maybe even 6% peak in rates in the UK. So I agree with you that stagflation is more likely in the UK compared with other countries. But I do think you're right. You have to look at it country by country. I don't think there's going to be a sort of an aggregate view. But of course, we should probably come on to China at some point, because China is a whole, they're zigging while everybody else is zagging, isn't it?
And actually, just before we get off that, I think I might have mentioned it last time, but I'll just reiterate it again, is I do think there's an element. I mean, last time we had food price inflation globally, we had all the Arab Spring sort of break out as people upset, and we saw a wave of dictators sort of swept from the various countries. Now, that's not because in emerging markets we're not seeing the same food inflation. It's not as much of a risk, but it's interesting the riots we saw in France, and while they're not notionally riots about food, I'm sure there's a certain amount of tension that arises from having food inflation at 10-15% per annum, while wages are growing at sub 5, and as you said, it affects poorer people more equally, and people might not even realize that that's part of what they're protesting. But I don't doubt that there is a link between I'm having a stressful time because I'm struggling to feed myself and my family, and then certain events happen, and then that's enough to sort of trigger riots where that might not have had as strong of an effect if you weren't also struggling to meet cost of living pressures.
No, I think that's a good point. And the other interesting observation, again, in the UK, is they've been reporting the latest credit growth numbers. And there's a very significant uptick in credit card debt, personal lending, personal loans, all of those things. And so people are now saying, well, we're not sure whether that's an indication of households being confident, so they're borrowing more, or whether they're desperate and borrowing more. But if you look at it as sort of a more granular level, and I've started to run some surveys in the UK, I'm not going to publish them yet because I'm still calibrating them. But the growth in debt is amongst those that are actually more stressed, precisely the same as happening in Australia. So to my mind, the uptick in credit is more to do with pressure rather than actually to do with just feeling great and borrowing more.
Yeah, that's right. I've got a chart just up showing the Euro Financial Conditions Index, and it's probably, before we get onto China, it's probably worth I guess my two quick comments on Europe was, one, you look at this, and this is basically tighter financial conditions versus looser, and usually what that means is the banks, this is coming from banks, it's bank surveys, the banks won't lend to people, or they're much more stringent about their lending criteria, and then that slows down the credit, and then because the credit slowed down, that sort of then slows the rest of the economy down, and then you actually start seeing companies sort of fall over. And so you can sort of see the last two times we had anywhere near this level, well, one was financial crisis, and I guess we all know what happened there, and the second was the Euro crisis, a couple of years later, when we went through that whole Euro crisis. And so in terms of financial conditions and European banks' sort of willingness to lend is at pretty poor levels, and then when you sort of compare that again with manufacturing confidence, which is just sort of tanking and really we'll flow on to that, because I think Europe is quite linked to China, is actually more linked to China than say the US, in terms of it's from a manufacturing sector, it's got more exports into China of goods that then to sort of can come back as finished goods, and so particularly in Germany, has got a very big two-way relationship with China, and so I do think there's that tight conditions with low confidence is not the type of setup you would be. That's certainly the type of setup you'd expect to lead to a recession.
absolutely.
You wouldn't want to be paying record prices for equities in that environment.
And just on that, let me just pick up this question because it was actually quite a good one from earlier on. Do you think the RBA is not aggressive enough to hike to combat inflation compared to the rest of the world? Because the RBA, of course, didn't lift rates, and rates in Australia are significantly low. We have the Fed lifting, we have the Eurozone lifting, the ECB is expected to lift further. And relatively speaking, interest rates in Australia are significantly lower. Now, there's a couple of arguments. The first is, of course, well, in Australia, we've got a lot more variable debt, so mortgage rates go higher.
And a lot more debt as well.
A lot more debt. So it's bigger debt and more debt. And that's one reason why the RBA might be a little bit more sensitive. And I guess the other question then is it more a timing question? In other words, will they have to lift again? And I think people are quite split at the moment as to whether the RBA has reached the peak or not. But most people seem to be suggesting they probably will have to go a little higher. Unemployment is really low in Australia, right? And but Michelle Bullock is
and
now
wage
saying,
growth is really low though. Like they keep talking about they keep saying, oh, we don't want to let wage growth get out of control like we've seen elsewhere. And you're like, but it's not out of control. It's like it's basically at the level you want it at. Like it's at, we're at the sort of peak boom raising interest rates and complaining about, maybe we need to cut off, this wage growth. Now, we're not the US. Like, we haven't seen the same types of wage rises. We're running a record amount of immigration, which will hold wages down in its own right. For me, the big parts where we're seeing inflation is partly within that food stuff we were talking about, and then is that a developed market issue? Look, quite possibly. So if that is the case, then that probably will come down. But the two big ones, one is energy, where we've basically decided that we're going to let the energy prices, energy companies charge whatever the hell they want. It seems like we've disconnected. We're basically the world's biggest exporter, paying pretty close to world record prices for gas. And that's on the East Coast, not on the West Coast, because the West Coast has reservation, and so their prices are pretty reasonable. So we're basically letting that energy inflation flow through to consumers, and the price caps that were sort of negotiated as fixing this whole problem. That's for people on contracts. So that's generally basically the manufacturers, some of the bigger manufacturers. It's basically we've thrown the consumers to the wolves. Basically said bad luck, So that's on the energy side, and then the other one's the housing side. And higher interest rates doesn't help the housing, especially not when we're bringing in as many people as we possibly can. It's actually hindering the housing. And anyway, the housing's it's takes a long time to build a house and a much longer time to build an apartment. And so having higher interest rates, is that going to stimulate more houses that will then house the people who are who are flooding through the doors, or is effectively the RBA saying, well, I need to cause a recession in order to get more people to move in with each other. So I need people to lose their jobs so that we can get rental inflation down. Now, if that's their plan, then yeah, sure, they've got more rate rises to come. I find it hard to believe that they're genuinely unaware of that sort of that push pull, is that interest rates are not a solution to short-term housing shortages because you're running massive immigration. So I guess I would say that the RBA has done enough, and probably we'll find out that eventually they've done too much already. I think the thing I worry most about the RBA is, that we've spoken many times and shown that chart. I haven't got it with me today, but that chart, we're just showing about how bad they are at forecasting wage growth. They always think wage growth is going to, get out of control, and so we've always got to be really careful about wage growth. They admitted it a few years ago and said, okay, we've got to stop forecasting wage growth and actually just wait until we see it. And as soon as we started seeing wage growth in the US and elsewhere, they were like, oh, well, we're seeing wage growth in the US, it must be coming to Australia as well. And it hasn't. And so, it hasn't in any major sense, like in any concerning one. We've got wage growth of, what's the latest numbers? 3.5, is it?
Yeah, it's under 4. Yeah. Interestingly, in the UK here, teachers have just settled for a 6% wage increase. And some of the people in the medical area at 7%. So you can see that in the UK, the wage spiral is definitely there. Don't see the same thing in Australia. And there's quite high migration into the UK, but not as much as Australia. And then Michelle Bullock, of course, in her speech before she was announced as the incoming governor, mentioned that they felt that unemployment should go back to 4.5% to be sort of where it should be, which is an interesting observation.
We need less people working. Yeah, that's our goal. Yes. Well, and so I guess this is my concern over. I guess we didn't really speak about. Was it a good idea to promote internally in the RBA? And my one hope from the whole process was that we got an external person. And when I say an external person, I really wasn't talking about somebody from Treasury either. I was saying, well, why don't we get somebody in from another country or someone who's done something else somewhere else that wasn't born and bred in the RBA and part of the group think, and will just give us more of what we've had. And so, I sort of feel as if we've done this big review and, we've identified some issues and a lot of them we've discussed on this show. And then we've said, let's just, appoint the next person in line. And surely that'll fix it. And what are we moving to 6-week meetings rather than 4-week meetings or something like that?
And the press conference, of course. Don't forget the press conference.
And press conference.
That's going to make such a big difference, isn't it? And I keep making the point, Damien, that it's not like the RBA's decisions were so out of kilter with everybody else's around the world. And around the world, they've got different mixes of boards, and they've got different press conferences and different cyclical moves. It didn't really tackle any of the fundamental issues. I was very disappointed with the review, and I agree with you. They should have brought someone in from outside. And by the way, just to give you a little bit of flavour there, the Bank of England is doing a review of its forecasting, and guess who's going to be looking at it? Ben Bernanke.
All right. Excellent. So what's his statement again? Looks like contained. The subprime seems to be contained.
Exactly right. Yes. The man who knows everything. And anyway, very interesting.
Anyway, but at least it'll
be interesting.
I feel as if he's probably more introspective though than say Greenspan. If you had Greenspan doing it, I feel like I'm hoping Bernanke seems to be the type of guy who might have learnt from his mistakes, whereas I'm not quite sure.
Well, he's a Nobel Prize winner, of course. So, what do you expect?
Yeah, exactly.
Let's talk about China, because China, of course, is, as I said, is zigging while everywhere else is zagging. There's almost no inflation. There's high unemployment.
There's deflation. And then, producer price indexes are all tanked.
Yep. And of course, because of the fact that Australia is very reliant on what China does, that's going to be potentially another downdraft, which could have an impact on the Australian economy too.
Yes, absolutely. Now, I'll start with a chart I've got it here on. I've got a couple of charts now. I want to talk in big picture terms, because I do think there's been a growing sort of vibe, to the best way to put it, in terms of the research that I'm seeing, which is basically like, China's solved. They've done enough. This will be whatever. It's not going to create a major issue, and I'm not quite as positive as on everyone else. So I've just got this. This is that zigging versus zagging. It's the economic surprise index. Basically what these do is they just go what were economists forecasting, and then where do the numbers come in? And you can see that last couple of months where the white line, which is China, is running well below zero. So most of almost 75% of numbers are all coming in below expectations, and the US is the reverse in terms of stuff is all coming in much higher than expectations. If you look at the most recent period, we had so these are the purchasing manager indexes. And so what these are, this is surveys. And look, the data it's very, very timely, and it's very forward looking. And so it's called soft data though, because it doesn't always come through. And so what they do is they go out and ask a bunch of companies and a bunch of sectors, and what are you doing next year or next month? Are you going to expand or contract or stay the same on a whole bunch of different things? And so the purchasing manager indexes for manufacturing has been running below 50, which is basically means that they're contracting for 6 or 7 months now, I think. The services has held up, but actually that's really come off in the last little bit. And the reason why it's come off is that top grey line, the construction. So construction for forever has just been this magical, things are always going to be better next month than what they were this month. And that really came off in the last few months. Now, what I guess I read from most Wall Street banks is, it's fine. They'll just stimulate that economy again. There'll be more. There'll be more stimulus and construction will get going again. And I've been watching very carefully because this really matters. And China knows that they've been building too much, and they've had 3 other goes at trying to fix this. And every time they've given up. They've basically had a quick go. Things have slowed down. So they did in 2015, things slowed down too much. They just reversed and started spending again. They tried again in 2019 and then reversed. And then we had just pre the pandemic, they were just starting again to slow down, and then the pandemic happened, and so they gave up again. So it's not unknown for them to reverse that, but it really doesn't look like they're going to this time. And it looks like there is a lot more at stake than what I guess people are worried about. And I think there's probably an element of boy cries wolf in this, in that people have been warning about ghost cities and overbuilding in China for 15 years now. And it's and so I think there's a fair bit of complacency, and I guess I'm a little bit less complacent, or a little bit less confident that everything's going to work out fine this time. So if we look at new starts, and this is the blue line on this chart, and then you look at the amount under construction, which is the orange line. So the number of new starts has more than halved. And just to put this into perspective, though, in 2007, which is sort of right back on the left of this graph, this graph starts in maybe 2002. In 2007, one of the Chinese premier at the time came out and spoke about how unbalanced it was and how they were building way too much. And then from that period, they more than doubled it, the amount of building, and they're back to the period. They're basically back to the levels close to where they already said they were building too much. Now the problem is, we really don't know what the hell's going on with these stats, because if I look at it another way, I could say, okay, we have starts with on this one's the blue line, same one that I showed you before. We've got this completions line, which is the orange, and then you've got the amount sold. Now, completions is like half of starts. Maybe it's come down to meet, but it's still below starts. So in theory, if you're starting more than you're finishing, the amount you're under construction should be just growing year after year, and it's not. It's already shrinking. So there's definitely some sort of disconnect with that. And then on the flip side, when you look at the amount of sales that have been going on, well, the sales are not significantly different from the starts. So there's still this big gap between the two. So we know there's just missing data everywhere. One possible way you could deal with this is you could say, well, what if I said that the amount under construction was the true number? And instead of using starts, what I'll use is like basically an implied starts. So if we said, so I've got the 3 numbers, starts, under construction and completions. And so at the moment, we've sort of been assuming they're all roughly right, but then we're missing like 3 billion square meters of property. And so if you did it the other way and said, well, what if we use the implied starts? Maybe that's what's been going on a little bit better. Because now that would say that, look, we had this big property boom in 2010 to 15. There was another boom sort of 2015 to 20, but actually that's died off even more now. And where that starts really has tanked, and that is gonna flow through to the actual number. Now, what matters to Australia is how much is under construction, because that's the stuff they're actually building and using iron ore and steel and cement, and all the bits and pieces, copper that goes into it. So if this is a sign of where it's going, it's got a lot further to fall. And then you look back at the developers and you say, and then you look back and you go, okay, well, what's happening with the stimulus then? Because there's all this talk of stimulus. And so the stimulus, though, really is basically saying we're going to try and let people buy more houses. We're going to have more debt. We're going to try and make sure developers finish the projects they've got. And the other one was doing the most recent press releases. We're going to have more food festivals. And it's sort of this weird thing about where the market's taken that to mean, hey, the whole thing's back on again. And that's the part I just can't get. Like, there's all this anticipation that there's going to be this massive stimulus, and it hasn't come. And it's not coming, or it hasn't come to date. It's going to take this dramatic flip. Like, basically, there was in some of the latest stuff. I should go back. A few years ago, Xi Jinping started to basically say houses are for living in, they're not for investment. We need to have reasonable priced houses for our people to live in, and that was sort of one of the mantras behind slowing the development down and actually trying to bring back this massive sort of construction boom. And in his most recent one, he's dropped it, and some people are then saying, well, that means it's all back on. He stopped saying it and it's all back on. Now, maybe that's true. I don't think it is, but what I would definitely say is in China at the moment, they're not reading between the lines on these things. So you can, Xi's had a pretty decent clean out of the whole political system there, and he's got rid of dissenters and people who complain and don't agree with him. And so if you're running a local government somewhere, and 5 or 10 years ago you were told to build as much as you possibly can, and then 3 or 4 years ago you were told don't let developers get any more debt, and you need to wind back and really crack down on these guys and don't let them do it. And that's been going on for the last 4 years. And then Xi stops saying crack down on these guys, but doesn't explicitly tell you to get out and try and reignite a property boom. You're not going to get out and try and reignite a property boom. You're waiting for Xi to tell you now is what, I'm not, you're not trying to read the tea leaves and guess what he wants. You're going, no, I will wait for him. And especially given your own budget constraints you've got. I don't think this, I'm waiting to see him actually come out and say the property boom's back on before I believe it, because the numbers are saying it's not on and the stimulus is saying it's not on yet.
Yeah,
and then you get into the Chinese developers.
Just one quick point. The other thing that I'm seeing is they're very worried about consumers, and so the stimulus pattern this time, if they do stuff, might actually be more to get more Chinese consumers to consume rather than actually the construction. So that could be a different sort of stimulus, even if it's a stimulus.
Absolutely. And we've already seen that in the stimulus that's out there at the moment. So semiconductors have been this massive winner. And that, which is going to cause an issue as well for the world. And there's another round of deflation coming because all those computer chips were missing from the cars. China's been building truckloads of factories to create sort of those low end chips because they haven't been, because the US has cut them out. So they're out spending hand over fist, and there's lots of government stimulus all pushed along that same line. So, in a semiconductors don't use much. They don't use steel. It's not a big part of those chips that go into your car. So it's definitely going to be that. The other thing they're facing is, I think they're up to 22% youth unemployment now.
Yes. And
the problem they've got there is that their education system has grown so dramatically over the last while, is that most of these are, or not most of them, but a very large proportion of these people are university graduates. And they're getting out of this university and going, okay, now I want a good job. I don't want to go work in a factory. I want actually an information and a job. And so if you're out building more apartments, if you're out building more bridges and roads and airports and things like that, just to keep the population, employed and busy, even though you don't need them, that's not what the that's not helping your unemployment and your problem with the younger. It needs a knowledge base. It needs a services based. So and there is broad recognition in China that is the case. I think there's the thought pieces and things like that you see from various officials over there talk about the need to really get consumption going. The issue is none of the policies are getting consumption going, and there's I would say it's an ideological view, probably from Xi himself, that when you do stimulus, you stimulate companies. You don't give all the money to consumers because they'll just waste it. You give it to companies, and at least if a company uses it and builds a new factory or a new road or a bridge, at least you've got a road or a bridge after it. If you give it to people, then they go out and spend it, and all they get is food or a travel experience or whatever it is, and so it's wasting you're wasting your money by transferring, because none of these policies are sort of designed to do that.
And I suppose
and it's okay. Sorry, yep.
Go on. So the implication, of course, if in fact the nature of the stimulus is different, they won't need as much raw materials from Australia.
Absolutely. Now, if this was any other country, I would say we're headed for an equivalent of the global financial crisis. They've done so much building, and there's so much over indebted, and there's so much excesses behind this that surely this thing's going to underwind. Now, I don't think that's necessarily the case, and it's probably not the case in China. You might have heard a bit of stuff about some of these Chinese developers and about how they're over indebted, and they've got problems raising debt and all these things like that. What you've heard is a couple of snowflakes sitting on the top of this iceberg. Like, when you look at these companies, it's just incredible. Like, the top 20 developers are just massive in terms of, if you look at the amount of debt and the amount of equity they've got, they're way bigger than the rest of the world combined in terms of the amount of developers, amount that they're worth in terms of the debt plus equity, and keeping in mind the debt. So some of the stats you would say you've got within that is that if you looked at the debt to equity for developers, it's basically, for every dollar of debt, there is almost $10. Sorry, for every dollar of equity within these companies, there's almost $10 worth of debt. So there is 10 times as much debt as what there is equity in these companies. The US, for example, as a comparison, the biggest developers over there, if you took a basket of say a dozen of those, you're talking about 7 cents. So for every dollar of equity, you have 7 cents worth of debt. In the US, in China, it's $10 worth of debt. If you look at then, and you go, okay, well, that's terrible. We knew there was all this debt, and so and China's just going to sort of help resolve it. Then you dig through some of the rest of the balance sheet, and it gets even worse, because you sort of look at these prepayments. So in China, they pay for the house up front. So you're getting a development. In Australia, you go, okay, here's a $600,000 apartment I want, and I'll put down whatever it is, 30 grand, 20, 30 grand, and then when the apartment's done, I'll pay for the rest of it. In China, they want the whole 600,000 up front, and then you're paying your mortgage before it's been built. And that's part of what people have been complaining about. Now, if you look at the amount of prepayments that the top sort of 20 odd developers have, it's 134% of sales. So basically, they've got the next year and a half worth of sales. They've already got the money for. They just haven't built the stuff yet. So not only are they in all this debt, but they owe the houses because they still haven't built them. In the US, prepayments for the US developers, it's less than 1%. So of your sales is in prepayments. Then you look at the accounts payable and the amount of accrued sort of liabilities you have. And so this is to your own staff and to all your suppliers and all that type of stuff. So in the US, and it's about 5.6% of sales, and for most people, for most places, you might be running at 30 to 60 days of that, and it's effectively like a bit of a freebie. So I've just bought $1 million worth of steel from somebody to stick up my apartment, and I've got 30-day terms, and so I can go and start sticking that up, and then I don't need to pay for that 30 days or 60 days that you have sort of within somewhere like Australia. And so it's like free funding I managed to get by that. In China, they're now up to well over half a year. So if they're 6 months behind effectively, or more than 6 months behind on paying their own staff and all the suppliers to it. Like, as you dig through, it's every step you take, it's worse and worse. And this is just what we can see in the accounts. That's clear in the accounts. Like, there's undoubtedly other stuff behind that we've got no idea about. And so I guess where I'm coming to from this is the only reason these companies are still alive is because the Chinese government has said they want them to be still alive, and they want them to deliver these bloody houses that they already took the money for. And so I guess what I'm getting to is, I think this sector's a utility now. Like, there is no possible economic reason you would be investing in any of these companies. There's no possible reason you would lend money to any of these companies. There's no possible money you would be a creditor. Like, you'd want to go work for this company and agree that they would pay you, or let them buy more. I don't want you to buy $1 million worth of steel from me because I'm still 6 months behind on the last time I sold you stuff. So the only reason they're still alive and still managing to do this is because they're backed by the Chinese government, and they're letting them do it. And I think that means they're just a utility. And so it probably means that the building won't crash. Like, if this was a normal country, all these companies are insolvent and they're pulling up stumps, none of them building anything else, and everyone's trying to work out how they're going to sort out the remains. It's not. It's China. China has sort of explicitly said it's giving more and more money to do this, but I can't see how it's going to grow. I just think it's going to have to tail off and just keep people employed at these things growing, keep the people employed at these things building until they've paid back as much as they can, and then maybe they let the whole thing implode at that point. But it's probably a slow death. Having said that, there is the risk that maybe something goes wrong and they do let some of this stuff starts to become inexorable, and whatever, you see some house price falls and you get investors get too nervous in China and stop buying stuff, and there's nothing the Chinese government can do about it. Maybe that happens, but in the interim, I think we're into utility, and it's just this slow grind away, and it's not going to be good for any of these commodities in the short term, and it's going to be terrible for these commodities in the longer term.
Yeah, very interesting. And it's interesting, Ben made this post earlier on, 1,700 building companies gone bankrupt in 14 months in Australia. I don't know whether the number's right, but we know vast number have fallen over in Australia. And we had a profitless boom. It was government stimulated, and all of that stuff we know. Very different, because as you say, in China, they're sort of, they're still keeping them alive, because I suppose the risks of them all collapsing maybe is too big, and politically it's political risk rather than anything else. But you then can't apply normal economics to it, can you?
No, you just and I guess that's where I'm trying to say it's a utility. And so and the one thing we do know about government utilities is they don't generally do stuff really quickly. If you're expecting a house price boom, and sorry, not a house price, a housing construction boom to come out of this, then you're expecting your utility who is full of these people who are, if you're working for a company and you're going, I've got $10 worth of equity, I've got $10 worth of debt, we've got to build stuff for the next year and a half just to pay off the people who've already given us money before, just before we made even on them. And then we're going to work for another 6 months just to pay back all the creditors, because we're 6 months or 7 months behind on paying everyone. And then after we've done all that, maybe we can worry about actually starting to make a profit again, and saying, it would be depressing. And I don't think you're going to get, I just can't see where it will need a 180-degree turn, and it will need Xi to come out and say, the house price boom is on. We're throwing all this money at it. We're going to government stimulate it, whatever it is. And you're probably going to have to recapitalize all these companies, because, they just can't, with what they've got at the moment, they just can't do it. So, but I think that's the much more likely scenario is we're just in this zombie fade where everyone's going to pretend that these companies are solvent. They're going to try and make them build all the houses that they've already been paid for and keep them alive until that, and then just start pulling the pin on them as they make the end of it.
Absolutely, which is quite an interesting observation. And by the way, of course, it isn't just Australia that's got a strong economic connection with China. The Eurozone is extremely connected to China. And one of the downside risks that I see in the Eurozone, where, of course, Germany is already in recession, where the inflation is still pretty high, seems to me that there's that economic overshadow, which is a downside risk in the Eurozone, which actually is quite different from what's happening in the US.
Yes, exactly. So this sort of all comes back from an investment perspective. You go, okay, China's really struggling and just going to be doing everything they can to make sure this thing doesn't collapse. So, their best, I guess in my sort of outlook, their best outcome is that they don't have a collapse, and they're going to have to do everything they can to make sure that doesn't happen. That's sort of happening at one stage. On the flip, on the other, they're being cut out of a lot of these markets from all the high end semiconductors. And so what they've done now is they've gone and built all these low end semiconductors, and what they're trying to do is exactly what they did on the in the solar side, is basically flood the market with cheap solar panels. So effectively what they did was flood the market with cheap solar panels. The solar manufacturers went out of business in every other country except China. And then they dominate, and then they can actually start scaling up, and they start to learn because they sort of hit the forefront of technology because they're the only ones left. And that looks like what they're trying to do in some of the semiconductors, the low end semiconductors. I'm not sure whether, there's going to be a lot more pushback this time. So there's already lots of countries concerned about that, the US in particular. And so, I guess what I worry about is the strategies that China is going to use to get around this are not going to be popular amongst other countries, and are probably going to generate more tensions rather than less.
Absolutely. And I suppose the other factor in all of this is if things are really bad domestically, then what you do is you actually make waves internationally, and you try and do a bit of deflection. Exactly. And it's interesting that I noticed that in China, Xi's just restructured some of the senior military people and kicked out of a lot of people, I guess, to build his support in that sector as well.
Yeah. Well, look, it's a genuine risk. It's as I said, I would have thought that if they actually allowed the property sector to collapse, and all these companies went broke and all these people lost all this money, you're into some sort of depression or whatever it is in China, and the CCP would probably lose power. There would be or you'd at least say their odds are probably better than probably aren't better than even in terms of managing to keep track of it. So it is for the political party within China. It's an important factor they need to keep on top of. Now they've effectively said to people, we're going to give you this great growth. In return, we're going to take away a lot of your freedom. But you've got this great growth, and your income's going to grow. And they've delivered for the last 20 odd years. And so, the life of the average Chinese person compared to 20 years ago is way, way better. Yep. Now the question is, you've got 22% unemployment from youth unemployment from all these graduates who are getting out going, I've done my degree. Where's this job I was promised? And it's not there. They're obviously not happy about that. There's a demographic time bomb going off at the moment in China in terms of the population. Every time we see an update to population stats, they're just worse and worse again. So are we going to see genuine tensions if the income stop growing? Maybe. So I think if that 20% unemployed or 22% unemployed keeps going, and those people don't find jobs, and as they get older, they're still finding, then you are going to have more civil unrest, and a time-honored way of getting rid of civil unrest is to start a war or start domestic tensions, as you said, draw people's attention away from their own domestic scenario where generate some patriotism, and then it's people are suffering suffering for the greater good rather than suffering because the CCP stuffed up, and so.
Absolutely. Well, it's a very important subject, and of course we'll keep a watching brief on China because it's such a critical part of the overall economy and quite a few different factors, I guess. Just one other question which came in from Jason, which we might just move on to, Damien. It was this. And thanks for the super chat, Jason. And this is talking about Australia. We'll soon be having to deal with builders cutting costs. Let's take the shortcuts to deliver as contracts, and build cheap and not to code. Absolutely, it's already happening.
But sorry, when wasn't it happening? When was
well, I was going to say it's sort of more of the same. It's been happening for the last 20 years in Australia, particularly with the privatisation of the certification processes, and we got to the point where effectively we know that some of the building contracts that are being signed is closer to 1% profit. No, nobody can survive on 1% profit, right? So the only thing they can do is to cut corners, use cheap materials, all of those things.
Go bankrupt, Phoenix the company. Yeah.
Well, that's clearly happening. So to my mind, I totally agree with Jason that this is one of the biggest risks in Australia. I wonder whether there's a similar risk across in China as well, that one of the things that they will do there is potentially to cut corners and cut costs and try and build those that backlog that they've got there as cheaply as they can. And are we going to then have just as we have in Australia with failure of buildings across China as well?
I mean, look, China's building quality standard of building quality is not the same as Western standards, and they had a lot of problems 15 years ago. And sort of, there's a bunch of photos you can see of just buildings literally falling over because they hadn't built enough foundations. They are a lot better now, but I think there's a couple of things on this front I want to talk about. One is that yes, there's potential. Secondly, most of the stimulus is all about getting the buildings built. It's not actually about outfitting the buildings. So there is a bit of a gap there at some point about saying, okay, you've got stimulus. I have an apartment now, but it doesn't have any walls or lights or any of the furniture or fittings and all that type of stuff doesn't have. So that's a solvable problem, I guess. I'd prefer to have that than no apartment at all. But there is that issue, and that the stimulus is around getting it built, not getting it finished. The other thing is there's been discussion in some of these later stuff about opening up the tier 1 cities in terms of more people can move to them and some of the permitting system and things like that. And in some ways that's really good because people obviously want to move to these larger cities. There's more work likely in these larger cities, and there's some of the housing markets hold up a little bit better and all that type of stuff. The problem is so many second and third tier, so much of this building is in the second and third tier cities. And so if they sort of put in these policies to open up some of the tier 1 cities, we might find that all these ghost cities you sort of see and sort of, I guess we've seen in the past, that can become even more prevalent in that, I guess the buildings, they might have been cutting corners, but it probably doesn't really matter anymore because nobody's living in them, or they're in cities that are actually seeing population declines within those cities. So, there's it is an issue, and I guess the part for Australia, in terms of cutting corners, it's obviously. Yeah, we fluctuate. I feel as if that pendulum is swinging back the other way, in that that's probably going to slow building down a little bit in Australia. In that some of that regulation will be a little bit more stringent than it was in years past. But those problems, when you build an apartment building and you don't do it right, that problem's there for a long time and affects a lot of people.
Absolutely.
Yeah,
And of course,
as I'm sure
people can lose a lot of money down the track. And the question then as to who pays. And in New South Wales, of course, where they've got lots of issues, some of the residents and investors are trying to get the government to pay for the renovations and retrofitting.
Yeah. Because I think some of the cladding stuff is talked about like 100,000 plus per apartment.
Correct, it's massive.
Fixing some of those.
Yeah, exactly.
Yeah, like it's just sort of, it seems weird. And okay, I bought my apartment, for whatever 500 or 600,000. How could it possibly just changing the outside cost me, 25% of?
Yes.
Well, and part of that cost you've just spent is the land cost, and so how can it possibly? But it's expensive.
No, it is expensive. And then Jason sort of followed up with this. So given the poor quality of construction, talking about Australia now, why would an investor buy into new properties even from overseas, is my wondering. Thought surely adds to less properties during the rental crisis. Well, there's two observations. One is a lot of the properties being built are being sold overseas directly by overseas companies. And in fact, it's a marketing-led thing, with the promise of revenue, returns, capital growth. So quite often, some of those overseas investors don't actually even look at the property, all right, and they don't go through due diligence.
Yeah.
The first point.
Yep. And I know that Docklands in particular was very well known for being marketed more overseas than what it was in Australia.
Correct.
When for selling apartments there.
Yeah, and we know the vacancy rates are very high. In the Docklands, a good example, right? So there are overseas investors who are holding those properties vacant. So they're not letting them. They're holding them because they believe that over the medium term the property value will go up. So it's a long-term capital appreciation hold rather than actually an investment property hold, and that's something which
and an insurance policy.
Good point. Yeah, exactly. And I think that's probably a lot of the rationale behind some of those investors. And just to underscore, a lot of those properties that are being built with foreign money, using labour, including some from overseas, to be able to actually then flog it back overseas. That's the mechanism that I think is not fully understood in the Australian context.
Yes, absolutely. I mean, and that's that. We've spoken in the past about that problem. An ongoing problem in Australia is the number of properties we've got that nobody lives in, and or people live in part time. Some of these foreign people, they come and visit. They go, I'll be here for a month over the in the summer to come and watch the cricket and the tennis, and then I'm back to whatever. So I think there's that, which I think is fine. Like I guess I'm not against any of this, but it is an issue if you're not charging appropriate levels of tax, and that's where the complaint I guess will be, is that if you have a foreign investor who says, yes, I want to buy this thing and leave it empty, is like, well, that might be fine, but we've still got to provide schools and hospitals and firemen and policemen and all that type of stuff to the area, and we've sort of built it all up to do that and all these services. And if you don't want to live there, and if you're not even living in Australia, well, at least you need to pay taxes to cater for that, and that's sort of not happening. At the level where we can then go and buy other things. So so that's but that's all. There's no real signs of any of that changing, I think, and that's I think there's I think we had a very brief period there where I think it was Joe Hockey was talking about cracking down on foreign owners and actually basically just applying the actual law that they had.
Yeah. And
then he was turfed as treasurer, and that all went away, and I don't think anyone else has been keen to look at it since.
Well, I can tell you that there are insufficient records in Australia to know where vacant properties are, who owns them, what the income should be, and then of course you add in Airbnb over the top as well, just to add that into the mix. There's huge issues there.
Well, and see, there's a number of countries overseas that have actually starting to put a number of the Airbnb. I think France was one of them. Yep. I think was in terms of being able to saying, okay, well, if you want to rent it all out for a whole year, then basically we'll treat you like a commercial property. Or if you so that it's sort of I can't remember what the limits are. Sort of if you're renting it out for 6 weeks a year or something like that, then it's fine. We'll treat you like an Airbnb. But if you're doing more than that, then it's commercial property, and let's charge you commercial property rates.
Yeah, absolutely. Well, it's in the UK here, in some areas now, they've really started to clamp down on Airbnb and are asking people to pay a lot more for Airbnb and then put rules around it and, a bunch of other regulations. Because in some coastal areas around southwestern England, for example, nearly half the properties in some areas are now let out short term, and that means that any locals can't get any accommodation. Well, Damien, we're coming to the end of the show. I got two questions to sort of finish off with. Firstly, in the light of this uncertainty, and we've been highlighting some of the uncertainties and the fact that there's a bit of a head fake going on at the moment, how's your investment strategy morphing or not? And bearing in mind that we've always said part of the trick here is to, what if you're wrong? What if you're wrong?
Yeah, exactly. So, look, one of the benefits has been over the last, or certainly the year through to June, was that the equity strategy we had in terms of looking for defensive stocks was meant that we actually outperformed. We outperformed that. So we on the Aussie stocks, I think we spoke about saying, we outperformed by 5 or 6%, and we were sort of top 5 in terms of the stocks there, and international as well, because we're in the right stocks within the sectors. So it was the stocks within that made the difference. Now, that hasn't been as much the case for the past month, or in the month of July. In July, we have seen the rally sort of broadened, and we saw more about small caps and other stocks of sort of starting to participate. And that's the part where that scatter plot that I showed you, like those periods don't tend to last. Like where it gets to the point where people are like, oh, it doesn't really matter whether they just had a 20% downgrade in earnings, I'm buying them anyway because I like the story. So from that perspective, I think there is an element of, yes, you do want to have some sort of equity holdings within that, but then also trying to work out which of the sectors that really have run hard and which ones haven't. Say at the moment, it's a question about looking at, we've been heavily involved in a lot of these companies that really have done well over the last month. Certainly on our international side, the sort of Microsofts and Meta was a big holding of ours, and Google and ones like that. It's now about winding back on those and starting to look for other sectors within that. So there's rotation within the stocks that can sort of help prevent some of that. The other side is the bond side. Now, over the last year, the bonds having that sort of longer term bond holding did help. The last month wasn't as helpful, but I do think we're reaching this point now where if what we're seeing is true, and that effectively that we are coming into this weakening period, and these events are starting to bite, then that's where you're going to get some protection, is holding that bond side. But as you said, nothing's about absolutes. Nothing's about saying I'm going to be 100% cash and then I'm going to be 100% equities and then I'm going to be back into 100% cash, or 100% pick your other asset. It's about having a reasonable spread between them and tilting in certain ways and going, okay, look, when the market's at record highs in terms of a valuation perspective, market's pretty close to record highs, and the earnings looks particularly weak. Okay, now's the time I want to be leaning away and not having as much equities. I still want to have some, but because you might be wrong about things, and could be positive surprises and breakthroughs. But you do need to lead away at those times, and then at other times lean back into the cycle, and I'm hoping to have a period where we can actually talk about leaning into the cycle and getting more equities. But at the moment, we're still sort of leaning away, and I guess it hasn't. We sort of feel as if for the last year it hasn't hurt that much. We've basically been performing in line with a market portfolio because of the mix of it. If it keeps running the way it's running, I'm going to underperform though, because now some of the wacky stuff that's going up that doesn't make sense. That stuff I'm not going to perform well if it's all these companies that are just downgraded by 25% and rallied their share price by 20%. But I do think that's a short-lived phenomenon, and it's often used towards the end of the cycles or towards the end of the periods where you do see that.
Yeah, absolutely. And you made a really interesting comment there. Things are not always logical, are they? The market can do dumb things, right?
Oh, well, look at and pick any period. Like, I mean, the pandemic. there was stuff going on there. This thing was clearly airborne. You looked at like the numbers we were looking in, and the numbers were sort of the cases were relatively steady, but the mix of it was going from like the cases were steady because you went from like 90% of the cases were coming from people flying in from China, and 10% were from local transmission, to exactly the opposite. 10% were from people flying in and 90%. And so the actual, you could just see that growth, and the market for 3 or 4 weeks ignored it before suddenly deciding, oh, actually, this is really important. It sort of rallied into that and then dropped away. And we were sitting there sort of going, are we crazy? Is there something we're not seeing here? Take the financial crisis. Exactly the same thing happened. The markets actually fell, had a big fall, and everyone's like, oh my God, here it is. It's all arrived, and then promptly rallied, back up to the same levels. And sort of, oh yeah, it'll be fine. Ben Bernanke came out. That's all subprime seems to be contained, and all this stuff like that. And then just before the whole thing fell apart again. So, not necessarily saying the whole thing's going to fall apart, but I don't think the imbalances are as bad as either of those times. But I do think there's some relatively severe imbalances. I do think there's slowing growth and potential for growth to slow quite markedly as the bankruptcies pick up. And so if shares were half their current levels, I'd be telling you to buy. Same economic environment, but with half the price, yep, absolutely. I'd be out there buying, because I'd be saying, oh, well, at these prices, who cares whether we have a recession or a mild recession or a medium-sized recession? It'll be fine to buy these things, and you'll see the price at the other side. I do have a concern about saying at record levels of valuation or close to record levels of valuation, now we want to jump in and buy.
Well, given where we think the winds will be blowing. Excellent. Well, as we come to the end of the show, any other last closing thoughts? Any news about Nucleus? Or
yes, I do want to bring up. I've got. You might be able to see the slide. We This came out a couple of days ago. So IMAP, which is basically a managed account, they look at the different types of managed accounts and run a whole bunch of different awards, and we're in the finalist for Innovation Award. So I've spoken to you before in the past about we've put a bunch of new features out. So we're doing fractional shares. We're letting people do tilts to their portfolios, where you can sort of decide that actually I just want some extra, I'll let Nucleus manage this part, but actually I want some extra exposure to, say, cloud computing, or I want some extra exposure to AI stocks. On top of also the ethical screens and things like that we've got in there. And we managed to get through in terms of the provider that's giving that has also got fees that are significantly cheaper than some of the other platforms out there. And so so that's good recognition that what we're doing on that front is innovative and market leading in Australia.
Well, congratulations. That's really good news, and well deserved. There's a lot going on, and as I keep underscoring, the way you do things and the transparency that you have and all of those things and the innovation, I think it's really worth people having a look. So, Damien, I want to say thank you very much as always. If people want to find out more about Nucleus Wealth, where's the best place to go to?
Well, the Walk the World Fund. That's probably the walkthefund.com.au. That's it. That's it. Right?
Yes, indeed. Yeah, links below.
And then, links below. And look, if you want to talk to a financial advisor, we have them on staff. You can have a chat about what you're looking for. There's we do sort of a number of quite often superannuation reviews. Sam in particular, who I think you've had on here before, is flat chat at the moment, sort of with a number of those in terms of just looking at people's superannuation, and really it's no obligation, no fee, just having a look and telling you, look, here's what we can do, here's where you might be sitting in things that might not be right for your risk profile, and actually sometimes it's just a matter of digging in and saying this is what fees you're paying, because sometimes it's not actually that clear when you look at these. We've had plenty of people who are like, I've got
fees
really low
not
fees.
Clear. Like, there's a surprise.
Really? Yeah, that's right. There's plenty of ways that the high fee guys can hide the actual fees and.
Wonderful. Well, thank you once again. We'll do it all again next month. I'm sure there'll be more to talk about. Really appreciate your time. Yes. Have a good evening. Thank you so much. I'm going to take you offline now and close the show.
Thanks, Martin.
Okay, so there you go. Very interesting and informative discussion from Damien. I hope you enjoyed it, and thanks for the questions. There was a question came in late about blockchains and things. I'm not going to cover that today, maybe another show. Just to tell you that next week, I'll be running the show here, and I'll be taking you through my latest mortgage stress analysis, and we'll do some postcode analysis. The week after that, I think I'm going to have Edmund on, because there's a whole bunch of questions that, Edwin, on talking about some of the property stuff that's going on. And so that's the plan for the week after next, as I say, next week, mortgage stress. And just to show you that the dogs do move, they've moved from their baskets onto the carpet, so they haven't gone very far. But you may have heard a couple of rustles as they moved around whilst I was running the show. So I want to say thank you very much for spending some time with us. Hope you enjoyed it, and I'll look forward to seeing you next week. This is Martin North from Digital Finance Analytics signing off. See you soon. Take care.